Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, January 26, 2024. S&P 500 currently sitting at 4,888. I'm David Zarling. I'm here with Dynasty Ian McMillan. 6 times the Chiefs are showing up to the AFC Championship game, Ian?
I'm grateful.
That's amazing.
I'm grateful. Lots of years of frustration. So
how far back are you going with that? Are you going like Alex Smith? Are you going Steve DeBerg? How far are we going with?
I mean, do you remember the Steve Bono days?
Oh, Steve Bono, yes.
Bono. I think we had Rich Gannon for a little bit.
Oh, the Gannon.
Like when he was on his downswing after the Raiders days. I feel like we had Rich Gannon for a year or two.
Well, you know that's our connector, right? Because he was a Viking.
And you had some good running backs over the years. But yeah, the last few years with Patrick and Travis have been, I do not take them for granted.
Yeah, please don't. Because 6 years in a championship game, and I know we were looking at
it's really hard in football.
We were looking at this before we hopped on here, but the difference between the teams that are in the AFC Championship game over the past 20 years versus the NFC is strikingly different. As far as 6 straight for the Chiefs, obviously we had the Patriots dynasty.
Yeah, 8 straight for the Patriots.
You know, Steelers. There was not a lot of other teams since the early 2000s.
Oh, yeah, I mean, it was Colts, Patriots, Ravens, Steelers. I mean, that was kind of it for a good chunk of a decade or 15 years there.
Where the NFC is all over the place. You had Seahawks, you had Packers, you had Giants, you had Vikings, you had Saints. I mean, it's much more diversified. We're concentrated on the AFC side.
That's right.
A little more diversified on the NFC side. And that's okay. That's what we love about these things. And I don't know that we normally jump off straight sports right away. You know, we haven't done some of those comparisons in the past, but we still have dynasties in front of us when we look at this year versus last year when it comes to the market, and the big keep getting bigger. As far as from a market cap perspective, 2024 is starting off a little bit similar to how 2023 was.
Yeah, we talked about it last week, and that continued on into this week for the most part. New highs for your NASDAQs, new relative highs, for NASDAQs and your techs, all those fun things that we spent all of last year talking about. You know, I guess today taking a little bit of a relative hit, but all things considered, another week in favor of growth.
When you look at
particularly the larger pieces of growth,
it's definitely
handed out, right?
It is. And, you know, we can make the argument that there's been a correction underneath the surface since mid-December, made new all-time highs and all sorts of indices between then and now, and that's okay. It's been a large cap growth tech story to start the year, and that's not a complaint. It's just a reality. When you look at what's positive year to date, it tends to be large cap, it tends to be growth, it tends to be tech. When you look at what's negative year to date so far, it tends to be small, it tends to be value, even mid cap. But that doesn't mean it's a negative. It's just trend.
Trend and momentum will moment. And we've seen this before. I mean, I'm not saying it's not frustrating, or I won't go as far as to use the word boring. I rarely ever think markets are boring. Yeah, do people kind of roll their eyes at the idea of the Magnificent Seven and, oh my God, this is all we heard about for 2023, essentially. And I will say, essentially done with the first month of the year. I guess that'll officially end next week. And then we'll have our answer to the January barometer, which should end positive, which would give us 1 out of 3.
Correct. We had a negative Santa Claus rally period. So the last 5 days of 2023 and the first 2 of this year, the first 5 days of January were negative. Now, a good seasonality information, but also coming on the back of one of the best Novembers and Decembers that we've seen. Now, if January is positive, Jeffrey Hirsch at Stock Traders Almanac and Kevin presented this at the client lunch and learn this last week. If we have one out of the three, but it's the January barometer that's positive, it's not necessarily negative as January goes. So yeah, like
so you'd say like
January,
the January barometer kind of as a whole trumps the other two.
yeah, I think that's a fair way to say it. If you've got a down Santa Claus rally and the first 5 days, but you're up. And the other thing is, it would also be extremely unique. This would be the fourth instance going back in time, 1985, 1991, 1993, and now here we are, 2024, that you would have a negative Santa Claus rally, negative first 5 days, but an up January. That's okay. It's more of a coin flip. It's not, I'm with you. What you just said, positive January has much more meaning than the first 5 days.
Makes sense. It's a bigger time frame of data than the others.
Yeah. And it's 1 out of 12, right? It's 1/12 of the year versus a few days.
I mean, getting off to a good start, which we have. I mean, we're gonna technically end if the month ended today, S&P up 2.5%, and surprisingly, now Russell down. Now there's some perspective there. Russell still leading the S&P off the October lows. So now there's a lot of angst out there with the Russell and what it's done. And I get a lot of comments about, every bull market I've been a part of, Russell, the small caps lead off the bottom, and there's a lot of angst because we'll have days where like staples get hit really hard. In fact, I want to say that happened Wednesday of this week. People will make comment, oh, well, staples they're supposed to go up just at a slower pace, not, get sold heavily. Well, when you zoom out, we've gotten a lot of things that people want and expect. Staples have gone up less than the S&P off the lows. Utilities have gone up less than the S&P off the lows. Small caps have gone up more than S&P off the lows.
That's a good point.
So the things that people, I know it's not all happening in the way that people want. And I think to your first point, there's this backdrop, Dave, of the frustration over large and mega cap growth. Like if you were a technician and you had a checklist of what you would want to see, let's call it, we are 3 months in off the bottom. Essentially, October 30th was the bottom. We're here at January 26th. Let's call it 3 months.
When you say the bottom, you just mean the flush that took place.
Yes.
August, September, October of last year.
Technically, you can say the bottom happened, October 2022. I'm talking about the most recent bottom. We dipped below the 200-day. We dipped below 4180 and then ripped higher.
What you're saying is a really interesting observation, because you're saying from then we've seen utilities and staples move higher, but on a relative basis weaker. You've seen small caps lead on a relative basis. You're right. That is worth paying attention to. That's information, especially considering where we are in relation to each other, bigger picture. Meaning, here we have the S&P 500 making a brand new all-time high. We haven't gone anywhere for 2 years. It's the first new high we've had in 2 years, so a 0% return for the S&P 500. Meanwhile, small caps are 20% off of their highs, like lower, but they're leading since that October flush. Is the table not set then? That's at some point or later this year that we're seeing small caps above 200 on IWM and leading. I think this is a tremendous observation that you're making off of the October 23.
Yeah, and it happened. And so much of it happened in the first 3 to 4 weeks. In the last 4 to 5 weeks have been sideways. So there's this recency bias that gets built up, and I get it. A lot of the intraday action in IWM, particularly this week, not super ideal. We will have Tuesday, Wednesday, Thursday, and today of this week, Russell gapped higher and ended up going red. Now, yesterday, I don't think it closed red.
Correct.
But I got a question for you, Dave.
Yeah, I'm ready.
So when you pull up a intraday chart of the of the Russell for this week,
Yeah.
is this? I'm personally split on this. I shouldn't have said that before I asked you the question because I don't want to give a bias. But do you see it as accumulation or distribution?
Oh, this week?
Yeah.
I think it's interesting because they ramped Russell futures in the overnight session up only to sell it right when we open. And I think they did that 3 or 4 days this week.
4 days in a row, yeah.
And so I guess what it tells me is if we're using Russell futures, that the 2011 and 2017 level, those are not years, that's a price level on Russell futures.
Okay.
That could be distribution in the very near term. And are we going down and testing a 200-day near 1850? It'd be tremendous information if we were above that 2011, 2017 area. That probably continues to confirm that Russell 2000 small cap strength that you highlighted from going back to October of last year. So is it distribution? When you look bigger picture, I mean, we still haven't cleared sustained trade above 2100.
I know that failed breakout still. The failed breakout from when that breakdown early January, yeah, like on January 3rd. That's still in the back of my head is kind of a little suspect.
So it could be distribution, but I'll also say we held the volume weighted average price from the 2021 all-time highs in November of 2021. We're still above that. I think it's so similar to how we talked about several weeks ago about the market the table being set for a market party after the flush in October and panic buying. I have the same sense or evidence from Russell 2000 that if we're above 200 on IWM and sustaining trade at any point this year, that we could see small caps just absolutely crush the broad market just when everybody was tilting tech and growth. Now, the only way that happens is if we're above 200. We're not there.
Gotta get there.
That's just a mathematical or numeric concept. You can't be above 200 unless you go through 200, and we're not there. So
you can't go to all-time highs. You can't go to 245 until, we're sitting at 195 now. So the way I learned it, you would have to go through 200.
If we're even just to get back to the all-time high from November 21, you got to go 23%.
Oh my gosh. Talk about failed breakouts. Ugh.
Yeah. We haven't really seen a situation like this, and that's perfectly normal in markets. You see the abnormal. The abnormal is normal in markets. Uncertainty is certain in markets. It's fat tail environments. You don't see S&P making new highs with the Russell 2000 20% off the highs. And there's two ways to view that. That is completely unhealthy. That's not what bull markets look like. That's definitely a thesis. And if that's true, then we won't see 4,800 on S&P 500 hold. We won't see 4,600 on S&P 500 hold. We're correct from here.
Yeah.
The other thesis is you have a catch up. You see small caps catch up to the other broad indices. And the only way that happens, like you were just saying, got to get above 200. Simple as that. You have to have a game plan. If you're going to take advantage of any type of rotation, that Russell 2000 200 level is a good place to look and compare that with the S&P 500 has done. And it has been large cap semiconductors. I believe semiconductors now as a so think about this. Semiconductors are a sub industry, are now larger than some of the sectors such as energy and materials of the S&P 500.
Wow.
Right? That's an interesting, and they've had a great run.
Yeah, put that. They made new relative highs, right? They're making new relative. Yeah, they made new. Again, today getting hit a little bit, but in the grand picture, that's
semiconductors are 4% of the S&P 500, which is larger than energy, real estate, materials, and utilities. So there's 11 sectors of the S&P 500.
Yeah,
it's larger than 4 of them.
That's wild. As someone who's really into like sub industries and stuff, and that's kind of how they're all divvied up. And obviously with the ETF, right, we know how many tiers you can go down. Yeah, that's pretty cool. You hear so much about stocks versus industries, and Apple's a bigger weighting than energy and utilities combined, or whatever it is. but to hear stats on sub-industries is pretty fascinating.
And NVIDIA itself is 3.7% of the S&P. NVIDIA is larger than the real estate sector. It's larger than the materials sector, and it's larger than the utility sector.
This is market participants, not journalists or some Fred data he pulled off the .gov website. So these are market participants, billions, trillions of dollars, and opinions, right? That's always the way I like to put. I mean, these are people expressing their opinions in publicly traded markets. It's a free market with all these participants, millions of participants and trillions of dollars, telling you that semiconductors are more important than the real estate sector as a whole. I could see that. I mean, like, as crazy as that sounds, I will say this: I own one house, and I couldn't tell you how many products in this house have a semiconductor in them. I'm sure almost all of them.
Almost all of them.
A chip, yeah, some type of chip that, whether it's Bluetooth or Wi-Fi or whatever it is, connecting them, and so I can stream Netflix.
Everybody walks around with a chip in their pocket. Everybody drives each day to work.
I mean, yeah, how many chips do you have in your car?
Right.
All the electronics are in a car now.
And semiconductors are kind of that digital transportation piece that's important to pay attention to. And they've had a really nice run. Semiconductors have had a really nice run. But I challenge any person out there who likes to look at charts. You pull up a chart of semiconductors SMH versus IWM, big picture. This would be a really logical place to see rotation. This would be a really logical place to see a move where semiconductors pause and small caps start to pick up a little bit of steam. It doesn't have to be like a wholesale
for years.
Yes, it could be a change that goes on for a while. And I think we have to be ready for that in this environment where, from a seasonal 4-year going into an election year where it's an incumbent, you tend to see this digestion in the first part of the year, weakness in March, and then you rally on for the next part of the year. The table does seem to be set for a catch-up trade for small caps for the second part of the year. Whether that happens or not, no idea. Tech and growth can continue to move higher. I'm sorry, what did you say there, Ian?
But I hope it's catch up and not
right.
Catch
it'd be a little more.
Right,
it'd be a little more. It would be problematic if we can't reclaim 200, and we see the S&P 500 lose 4,800, and more importantly 4,600, along with the 200-day. Now you're talking about a different type of scenario.
Yeah, 4,600. You lose 4,600. You're probably getting in the territory of also losing the 200-day, because it would be up there by then. Yeah, so that would not be.
When we covered some of these topics in the Lunch and Learn, like every month we do an in-person presentation. We also put it on YouTube for our clients and those who would like to attend, who are interested about what we're doing. We're a pretty transparent shop, but it is interesting just talking about the dynamics of reaching a new all-time high, right? Because the sentiment would then be like, oh, that's too high. All-time high is too high. Not true. They tend to happen in clusters. On the flip side, small caps are 20% behind. Also followed by the dynamic that the market doesn't really care about, first of all, doesn't care about what I think, doesn't care about what you think, doesn't care what about anybody listening thinks. That's lesson number one, which is a really hard lesson. Most people like to have an opinion and think their opinion is right. Market doesn't really care about your opinion. Point two would be, market doesn't care about calendar dates. I understand that the financial industry operates off of January 1st and December 31st. That makes sense. I understand you have to track something somewhere. But did the market really care that January 1st of 2023 was near a bottom? No. And same thing from,
did you ask it?
No, I didn't. And it didn't, back in January of 2020. So if you think about a trend following process, which is what adaptive is, and I apologize, so I'm going down a little education route on trend following.
Yeah.
The broad market using the S&P 500, all of 2022 is correcting. And on January 1st of 2023, all you've recorded in the S&P 500 is lower highs and lower lows, a falling 200-day moving average, several very important moving averages below the 200-day moving average. That is the very definition of a downtrend. So for a trend following process to be invested on January 1st, 2023, fully invested would be extremely irresponsible. So by its very nature, trend following doesn't catch market bottoms. It also doesn't catch market tops.
And
It catches
you've got a downward sloping 200-day until what? Like June?
June. Right.
Yeah, June maybe.
And our clients are familiar with our rules. We've posted our write-ups to our clients. And I believe it was 5 or 6 times that we highlighted the 3 things that we needed to see, which was be above a 200-day moving average, be above 4180, and sustain that. Those were the 3 rules. We didn't see that until June of 2023. My point being that trend following by nature off of a bottom is going to lag behind. And so if someone says, hey, 2023, you're lagging your benchmark, that is a natural progression coming off of a bottom, which we don't know in real time. So January 1st, 2023, we're still in a downtrend. And at that point, no one knows. And anybody who pretends that they do know, like, oh yeah, January 2023, I knew that was going to be a bottom.
Yeah,
maybe
especially then, like, I mean, even remove the dates from a technical perspective, you had just gotten rejected again off the 200-day.
Correct.
I mean, it wasn't, there's just nothing to do there.
And that's where, anybody that said, oh yeah, that was definitely a bottom, you can say that afterwards, right? That's called hindsight bias, or it might be confirmation bias, or sometimes, right, the bias where you go out into the marketplace and you buy a stock or you go buy a car, and it's because you bought it that you think it's important. The fact remains that January 2023, while it was near a market bottom, in that moment, you don't know that. And that also explains why you have a really nice return from the S&P 500 in 2023. And all that did was get you back to 0% for 2 years. We have to keep in mind how markets operate. And that's why it's also okay to say, is there more room here? If the return on the S&P has been 0 for 2 years, is there more room for upside? I think the answer is yes, especially if we're staying above 4,800. I don't want to overcomplicate things here. So I kind of went off on a little bit of a tangent there, but I think it's important to highlight trend and trend following, how that process works.
Yeah.
Ian, believe you me, I wish they woke me up in the middle of the night, shaking me. Hey, it's the market top, or hey, it's the market bottom. They don't do that. They might do that in other places, but not for me. What else are we seeing out there, Ian, that you'd like to highlight that you think is worth covering? Some important developments over the course of the last week that our clients and listeners would appreciate.
It doesn't get a lot of airtime, but an area that I think everyone needs to keep in the back of their head. This goes along with a couple ETF closures. I still think it's holding up pretty well on a relative basis, is financials. I'm not saying we are backing up the truck yet, but I think that they're holding up really well. And yeah, it's pretty positive. I mean, obviously that's based on the chart, that is subject to change. But I think financials, if we get to summer, like June, July, and financials are the top sector performing, I wouldn't be surprised.
That would fit that potential small cap rotation thesis.
I think banks have held up well. I think XLF as a whole is, when you look at that relative chart,
building a base.
Yeah. Nice retest.
You look at, you mentioned ETF closures. I'll even mention ETF openings. Last week we talked about Bitcoin. When you look at raw, like just BTC, the Bitcoin versus dollar, and compare that to regional banking, we're right at a level where it makes sense to reverse. And wouldn't that be classic? We launched these Bitcoin, it's the new era of finance. And from that point forward, financials lead us higher. We're thinking about.
It's an interesting chart there.
And when we look at a level for the New York Stock Exchange of 16,000 that you've highlighted numerous times, we're above that. Kind of pivoting back to, like, if you think about the composition of that, that's both domestic and international, but it's a really important level to hold 16,000. And my son, now what makes me nervous is my youngest son, when I was saying goodnight to me, told me that the Dow Jones is at all-time highs near 38,000.
Wow.
It was both a proud moment and then the sentiment gauge went off the charts.
Yeah.
What does it mean? Did my son just tell me he loves me, or did he just clue me in that
Where do you
everybody's
think he
winning?
finds out that information?
I believe it was called Current Events at school.
Okay.
And they covered that the Dow Jones had reached 38,000 and was at a new all-time high. And so that's exciting. That's a good thing. But I also get nervous when it's my son that's telling me that.
Okay. So, and maybe not, current events. I think
Let's
that's
just-
better than like me and my friends were talking about this at lunch, if that makes
Right.
sense.
Yeah, no, yeah, for sure. Or my wife or my mom text me about this stock called Nvidia.
Yeah.
I'll get a little bit more nervous when mom
I think
reaches
there's
out.
still a lot of I think there's a lot of disbelief, frustration, angst. Because this isn't what's the best way to put this, Dave? Like, this is not your 2020 rebound where lots of individual stocks were working.
Right. It's not as broad.
And people like individuals. I like individual stocks.
Right.
But I can also look at a chart and realize when should I be involved in indices and when should I be involved in exploring individual stocks, and we remain in a market that moves higher. So you flip on CNBC, you flip on the nightly news, you go to school and they're talking about it in current events. Stocks are making all-time highs, right? But to your average retail investor, it's pretty frustrating because the story stocks, they have their days. And we have days where breadth is good, but it continues. I mean, we're going on 14 months of this being led by this market advance, being led by, for the most part, these, we talk about the magnificent. Is it more than 7? Yes, it's more than 7. A 7 have a lot to do with it, but it's still a pretty small handful.
Oh, it is. And it is interesting. I mean, we do get to acknowledge there's two things. And some people struggle with paradox or duality, or that two things can be true at the same time, which is 71% of the stocks that are in the S&P 500 last year underperformed the S&P 500.
Wow. 71.
Yes. And we haven't seen that before. And we've got all these mega caps that are carrying the market higher. And that is perfectly normal momentum behavior. So both of those things are true. Was it narrow? Yes. I don't want to paint the picture that it was just 10 stocks. There were other stocks advancing.
There are other stocks for sure.
But 70% of stocks in the index underperforming the index, that it was carried by the large cap. That's also good for the league, right? We like it when Giannis is the guy. We like it when Pat Mahomes is the guy.
Yeah.
We like it when Apple and Microsoft are the guys.
And people complain about it, right? Oh my God, the Chiefs are in the play. Like, the league just wants the Chiefs to win, or the refs want the Chiefs to win, or this is boring. The Chiefs are in the AFC. Well,
yeah, Pat Mahomes pretty doggone good. And Lamar too, for that matter.
I know that's going to be such a good matchup.
It's going to be a fantastic game.
I don't even know what you do with Lamar. I guess keep a QB spy on him or something all game.
You might need 3 spies. You got to guard everybody else with.
I mean, you could put Karlaftis out on him and maybe a QB spy, but the guy still is Lamar the most athletic NFL quarterback?
In the current era, yes. I'm going to go. There was an era of Randall Cunningham.
Yes.
And there was an era of Michael Vick. Michael Vick was ridiculous.
Yeah. But
like,
Lamar,
I'm not saying
he's up there. It's just, I don't think it's as simple as like keep a linebacker in the box and spy on him all game.
Yeah, because the linebacker's not fast enough to stay with him.
Well, yeah, and if it's just going to be, it's one-on-one and it's a race to the sideline, it's a race to the first down marker. I mean,
right. Yep.
You know who's going to win that.
But yeah, and that's good, and that's good entertainment. Like, I'm gonna watch that game because I want to see what Pat's gonna do. I want to see what Lamar's gonna do. It's the same thing with markets. I'm not here saying that 70% of components underperforming the S&P is bad. I'm just saying it's a dynamic that we haven't seen in a long, long time. and now you have tech representing 30% of the index. We haven't seen that since the 2000 top. And again, people will be like, oh, then that means this is the top, right? No, think about it. We've gone 23 years without tech having this type of leadership. It's gone sideways. It's had tech versus S&P has a 0% return from 2000 to 2023, 2024.
Well, and to add to your point, I think we've talked about this before. Let me make sure I'm speaking correctly here. In the 90s, so we had our 98 correction, right? I think that was like July through October. NASDAQ made new highs by December. We don't need to talk about what happened with the NASDAQ in 98 and 99. That's a pretty well-known story. Small caps made new highs about 14 months later.
Okay.
So here's the thing. Are you willing to say this bull market sucks? There's not enough breadth. There's not enough participation. I'm just skeptical. I'm going to remain on the sidelines. Well, if you had done that in 99, missed out on a
pretty good move.
87% run in the NASDAQ.
Yep.
Because you didn't think overall breadth was strong enough to participate, or you were skeptical of it. I'm just trying to put it in perspective.
Well, and the perspective is we're not really that far away from the breadth expansion we saw in November. Is it really that bad of a deal to see breadth cool off?
The Russell is still leading off the most recent lows.
Which I think is the best observation of this episode, by the way.
Yeah, I know it doesn't happen the way, because it happens in this big spurt and then it's sideways for a long time. And people throw up their arms. And I get it. But again, big picture perspective. I mean, even if you look at relationships, Dave, I mean, didn't we get utilities and staples at new relative lows this week?
Yeah, versus the S&P.
And then if you take discretionary versus staples, okay, I mean, it's still in an uptrend. It hasn't had the best. It's January. But big picture, you definitely want to own discretionary over staples.
Are we really getting that bearish if things
high beta low vol continues to work higher?
Yeah, if we see Google making new all-time highs, Meta making new all-time highs,
Berkshire Hathaway, JP Morgan,
Visa, MasterCard.
Yeah, you got them on here too. Yeah.
American Express,
Costco. The credit cards, Costco, yes.
So are we really getting that bearish if we continue to see, yes, I get the mega cap thing, and you have this can't say sleeping giant. What would you call a sleeping small caps, sleeping tiny hats underneath the surface, waiting to be rotated into? But these other things, they're consistently risk-on characteristics. If you're seeing credit cards and Costco and Berkshire Hathaway and JP Morgan and Google and Meta going out to new all-time highs, that's very characteristic of a healthy market environment.
Well, okay. And so, markets bottomed October 30th. We're going to call it. So in the next 2 months, from end of October through end of December, you had small caps rally 26%. As much as everyone would want that to continue in a straight line, let's just annualize. Let's just annualize 13% a month. That's just not the way markets work. It's okay. It's okay to go sideways.
Well, and that's kind of the seasonal period we're in, is the move that we've seen the last few weeks from NVIDIA, from semiconductors, from tech. It would be perfectly normal if in 3 to 4 weeks, you and I and our listeners are twiddling our thumbs because the market's gone sideways to digest this move. Meanwhile, quietly underneath the surface, financials move higher, small caps move higher, and that doesn't get all the press because it doesn't move the indices. If NVIDIA...
No one owns Bank of America.
Right.
No one cares about all your boring banks.
Right. If NVIDIA is 1/3 or 1/4 of financials moving higher or small caps moving higher won't be all that noticeable. And that's where we are from a seasonal perspective, by the way, is we tend to be higher at this point in an election year with an incumbent. And then we kind of move sideways and maybe even correct into the Ides of March. We might be able to move higher into
I
Valentine's
think
Day.
Apple is one too. I'm kind of topping out here again at 196, 197.
And so it would make sense to see some digestion here that would be perfectly healthy. I think it's a really amazing observation that from the October 2023 flush, that we've seen small caps lead. That is worth paying attention to. We haven't even talked about bonds. And it's sometimes,
what do you think about rates?
if you look at 10-year treasury notes being near 4.1, and that's the same level we were in October 2022, and that's where we saw most stocks bottom. And I know you've highlighted on here that sometimes it's not the level of rate, it's the rate of change of the rates. So if you've seen nothing but, kind of a sideways move out of rates, that can be a really positive environment. And, Kevin did a really good job in our presentation this week, just highlighting how bonds as an asset class are acting more like stocks now. They're highly correlated. The volatility is the same. The 60/40 portfolio that continues to confirm that the 60/40 portfolio is problematic because no longer you risk parity, right? The teeter totter of risk being where, if stocks are weak, bonds buoy the portfolio. They're now moving together. So really, what is the advantage of holding 40% bonds in your
long duration bonds back below their downward sloping 200-day?
Yeah. So the correction begins. So here we have the S&P freshly new minted all-time highs, but yet you've got long duration treasuries and aggregate bonds in ongoing downtrends. I don't know that you get to say that bonds are risk or low risk adventure, because it's all we've seen bonds do is correct since the beginning of 2020. And that goes back to, are we in a new 40-year cycle of lower bonds and higher rates? We could be, and that's why portfolio construction, our clients are familiar with that. We're not on the long duration of bonds. We're owning the short duration. If we're owning bonds, it's like T-bills and floating rates.
For the models that can have fixed income exposure, I don't think we've had long duration in
a long time.
It's easily 2 years.
When we don't talk about bonds on here, or we don't talk about commodities, or we don't talk about international stocks, part of it is simply because those things continue to be in relative downtrends. They continue to be opportunity costs. And believe you me, I loved the first quarter of 2022 when commodities were the place. Like that was, you had relative strength, you had absolute strength out of commodities. That's not there. So when we don't talk about some of these things, don't view it as we're overlooking them. Keep in mind that we're a technical analysis shop and we look at relative strength. When you look at bonds versus stocks, downtrend. Commodities versus stocks, downtrend. International stocks versus U.S. stocks, downtrend.
Downtrend, yeah.
There's really nothing necessary to cover. Now, I will say the dollar, trade weighted dollar, being near a 200-day moving average in the 102, 104 area, this is really interesting.
Yeah. What do you think about the dollar?
I think it's interesting that the narrative is still out there about losing reserve status.
Like as a world currency reserve?
As a reserve currency of the world. And remember in the summer of last year.
They say that about us?
And that's just it. And what I like to remind clients of is the dollar, yes, we say it's backed by the U.S. government, but what you're really saying is it's backed by the U.S. worker. That's who pays taxes. And I will make bets on the U.S. worker 8 days out of the week. Like, I see what you guys do on the adaptive team. I see what everybody does here at Client First. I see out there what people are doing. The American people work their butts off. And yes, do they pay taxes? Do they grumble about the taxes they pay? I get it. Do taxes go towards things they don't agree with? Yes.
Yes.
But the American people are a productive group, and that's what the dollar is based off of. Now, are there things on the periphery that where you could, and I'm not going to go here, but are there things where you're like, I'm a little concerned about productivity because of this type of social dynamic that's trying to be pushed? Sure. But I also agree that for the narrative of how much time is being spent on illegal immigration, which rightfully so, I get it. that there's also legal immigration, and those individuals are some of the hardest working on the planet. And so here I sit there and I go, the dollar's backed by these individuals. When we look at the trade weighted dollar, is it collapsing? No. Is this an important area? I think you'd agree, Ian, 102 to 104.
Very important. We're just
pretty important.
Stuck at this 200-day. If it breaks higher, is that bad for stocks? I don't think so. Is it a headwind for small caps? Yeah. It will continue. I mean, if we get above 104, I would expect for growth to stay in the lead. There's a lot of mega cap companies that are worth hundreds of billions or trillions of dollars. They can absorb 8% interest rate a lot more than a smaller, domestically run. And we've talked about this, right? Just more resources in general when it comes to, there's a lot more things at their disposal when you're a multinational conglomerate like these mega caps are versus John and Joe industrial supplies, small cap.
When we look at going back to the comment about trend following in January 1st of 2023, when we really look at when a lot of stocks started to bottom, now that we now know, and looking back. So I got to be careful when I talk about these things, because sometimes I just don't want to give listeners the impression that, oh yeah, we knew October 22 and January of 23 were the bottom. No, but when we do start to look at that data, and that was a bottom, it is interesting it's very clear that a weak dollar has been a part of that from that point. The trade weighted dollar got up into 114, and we've done nothing but cool off since then. So this 102, 104 level, to your point, Ian, is it's pretty fair to say that if we stay below 102, 104, if we're seeing a weakening dollar, that is very supportive of stocks moving higher domestically.
Agree.
You compare that with the move we've seen, though, from last year's fourth quarter bottom in late October, early November. This is a very logical place where we would see digestion. Doesn't have to happen. We could move a couple percent higher and then digest. But all of this information, though, the breadth thrust that we've seen last year, the leadership that we're seeing out of semiconductors and tech, and you mentioned, are we really getting bearish if major financial companies are making new all-time highs? All the information continues to be constructive towards a 2024 that is another nice return year, but we don't make predictions. We have a plan, and really it starts with that 4,800 level on the S&P 500, 4,600 even more important. Could we pull back into those? Absolutely. 5% corrections are normal, and that's happening going into the Ides of March, and then we're moving higher from there. Time will tell. We've covered a lot of ground, Ian. You've done a great job. Have I missed anything? Is there anything you wanted to touch base on that we haven't yet before we bid adieu?
No, I think there's still some participation is lackluster. You can look at a multitude of breadth levels and see we've kind of petered off over the last 2 or 3 weeks, but indices continue, or at least 3 of the 4 indices continue to march higher. One thing that kind of has my interest is the number one stock in the Dow, UNH, United Healthcare. Yeah. Unfortunate week this week. That needs to fix itself.
Yep, and the largest.
I think long term, there's a base here to build out going back to early 2022. I mean, you zoom out on that chart, it definitely seems like we are trying to build the right side of this consolidation under 550. We'll call it 550, but something I would like to see get fixed. McDonald's failed breakout, another big down name. So there's some things out there, but I got, this goes back to our point, Dave, of it is a mega cap growth market.
It is.
And it's hard to hate on the Dow. I think the Dow got to all-time highs
first.
Yeah, like mid-December. So it's again, big picture, kind of hard to give the Dow crap when It got to new all-time highs first, so it's kind of a leader up there with the Nasdaq. As odd as that sounds.
Well, and you mentioned, I think it's interesting. There's a couple dynamics in the background. We've covered the breadth piece. When we look at healthcare, right? Healthcare sector is the third largest in the S&P 500. If you see healthcare, this sideways range it's been in since 2021, move higher, obviously you'd want to see United Healthcare lead that. That would be a really important dynamic. And then you brought up the Dow Jones. Underneath the surface, you have the Dow Jones Transportation Average. So if you're looking at Dow theory, it has not yet made a new high, but it's a really constructive sideways range that's gone back to 2021. And if we see that break higher, that would be confirming. That would be a major confirmation of Dow theory, which is comparing the industrial average versus the transportation average. There's a history there that we don't have to get into since we're up against the end of our time. If healthcare goes out to new highs, led by United Healthcare, further confirmation. If the transportation average,
yeah, healthcare's there, man. Healthcare is not a bad weekly chart,
right? And if that's making new highs, the third largest sector, transportation is on the verge of making new highs. That's confirming what the Dow did. All these pieces continue to line towards positive, and it gets me excited because from an uptrending perspective, broadly speaking, broad indices speaking, consistent uptrend. We had the beginning looks of that in June of last year, confirmed by the fourth quarter. We haven't seen that since 2021. So it's been a little while since when you had a sustained uptrend. And if that's continued to be confirmed that that's what we're in, people should enjoy it. Enjoy that.
I'm going to be honest with you. There are not, I'm not going to say it's a majority, but there is a significant amount of people, market participants, that I am convinced are not enjoying this. And then we have like a record. Now, this is kind of a law of big numbers thing, but also then we have like a record amount of cash on the sidelines, like $8 trillion in cash.
Yeah, when you look at the inflows last year into money market funds, it's record breaking. There's actually net outflows out of equity funds last year and net inflows into money market. Now, there's a few ways to look at that. I don't know that you can go one-to-one. I'm guessing it's a combination of if you have good fixed income managers out there, that some of the money that's going into money market is fixed income, right? Because if that's generating 4.5 to 5.5%, and you don't have to deal with the duration risk volatility, you're probably owning some of that money market. To your point, yes, there is a lot of cash on the sidelines. People should view that as stacked firewood. If that gets lit, if that starts buying stocks, that's the demand that the market needs to move stocks higher. Absolutely. I think that's what your point is.
Yeah, I mean, risk-free if 4% feels good until
the market moves.
Equities are ripping, and now it's not keeping up.
And it goes back to, like, I know the topic du jour is dividing stock prices by inflation. But but we don't see people doing that with short duration
is that
money
really
market.
A thing?
Oh yeah, people are all about saying like, well, that inflation adjusted, it's actually this. Well, that's fine, but then do inflation adjusted versus the 5%, because that's worse. So however you want to slice it, that's called opportunity cost. And wouldn't you know it, when the topic du jour is, can I just go in a money market? Can I just go in a T-bill and get 5%? The market continues to rip higher.
I don't know. Stocks divided by inflation, that feels like that feels like some big copium going on. Like, yes, we're really trying to justify not owning stocks or something.
Yes. Yep. Yes, it very much has that. It doesn't reek of euphoria.
No.
And that's probably where we're at, is from a standpoint of we're somewhere around skeptical. And
you had a poll on that, didn't you?
I did, and the majority fell between skepticism and optimism. But you also have to know your audience. It's probably most of the people that they understand. Yeah, they probably understand our thinking on this. But when I observe our clients, or I observe financial media, I definitely do not get the sense of euphoria. I get the sense of one foot out the door if they're involved. I get the sense of some are not involved, and therefore it can't be a bull market. We're somewhere between skepticism and optimism is my interpretation. Again, that's a subjective, non-numerical, I can't quantify it other than my sense of financial news headlines and interactions with clients. What do you think? What is that kind of
I
where what
think
you sense to?
if I could paint a visual for the people of Wisconsin, Minnesota too, the way I see it is a lot of people out on the lake, they think the ice is really thin. A lot of people are making it halfway across the lake and turning back. But I don't think the ice is as thin. I think it's an optical illusion.
Oh, you think it's like super thick and like
Maybe not thick, but I think it's safe for people to trek across, and you've just got too many people on the perimeter telling,
there's too many naysayers?
yeah.
Or what about this? Or what about that? Or what about interest rates? What
Right, and
about
I get it, and I
dollar?
get it, and and there, it's not even just headlines; it's people and their personal experiences. And the economy can't good. My groceries bill is up 35%, and that is absolutely true. I think I think we don't need to get in here and talk about the inflation that people have experienced in families. No doubt that every family in America has experienced quite a significant uptick, if you want to keep up with your same lifestyle. But again, that doesn't, your day-to-day frustrations with the economy does not really play into what the stock market's doing.
Yeah, for sure. And, as we highlighted during the presentation with our clients this week, we did have the market correct in 2022 north, greater than 20%, almost 30%, and in many areas, way greater than that. And they revised GDP just recently down for that time period. So the market was right again. The market really doesn't care what we think.
Well, and how about that? We've seen the NASDAQ has been a drastic outperformer, right? A pretty drastic under. I mean, the NASDAQ, speaking of 2 years highs, is just getting to 2 year relative highs.
Correct.
We talk about the outperformance in NASDAQ, and we're, Magnificent Seven ad nauseum. Trust me, no one gets it. But from a big picture perspective, that outperformance has just now, as of last week, gotten back to where we were late 2021.
And arguably even late 2020.
Yeah.
So you're talking about almost 4 years of relative sideways with a drawdown in between. And
On a
even
relative
bigger
basis, the S&P and the NASDAQ, and again, recency bias, right? It's been 14 months of, golly, I didn't own these 7 stocks and I underperformed.
Right.
And I hate to be the bearer of bad news, but yeah, we're just getting back to even on that, and our very good chance we're headed higher in that relationship. I'm just saying, based on the trend.
Yep. And that's why we use absolute relative charts. We use price. We don't use financial media to make decisions. We don't use gut instinct. It's not some black box. It's not a predictor, but we're using technical analysis, the study of supply and demand, the interaction of market participants across the globe on their prospects on what things look like 6 to 18 months in the future. And I can't imagine not using charts and technical analysis to identify those themes and manage risk. And by using those tools, it's very apparent that we're in a healthy market dynamic. The thesis that we unveiled in late October of last year continues to be the thesis. Do we see digestion? Most likely. Could we see 5%, 10% pullback? Well, on average, you tend to see 5% pullbacks in a year and 10%. So yes, will there be volatility? Absolutely. Is there market health? Yes. Is there a chance for even further market breadth expansion? Absolutely. If you're seeing Russell 1000 equal weight above 44, and if you're seeing IWM above 200, we've highlighted on the areas that are worth paying attention to: 4,800, 4,600 on the S&P. Everything I just said doesn't matter unless we stay above those levels. So Ian, another great episode. I think our listeners are going to love this one. And if you guys do, if you've listened to this and you really appreciate it, please share it. Please give us a high ranking. That gives us confirmation on that we're providing value. out in the universe to you guys, that would be much appreciated. Ian, any last call? Anything else before we say goodbye?
I don't have anything.
Okay. I think I'm really excited for another great AFC championship game. I don't have a dog in the fight like you do, but I think it's going to be an awesome game, and I hope it goes your way. Thanks for
I
another
think
great show.
both the games on Sunday this week.
I think so. I know for
Yeah,
sure.
I don't think we get any Saturday football. I don't think we get football tomorrow.
Maybe there's some good college basketball. I don't know. But
Should be.
appreciate you. Another great episode. Thanks for participating. Thanks for everyone listening.
Have a great weekend, everyone.